Hey, what is up everyone? It's David here. In this video, I want to try and answer the question whether growth stocks are back on the table. And I want to answer that question by looking at some of the updates that was provided by the Federal Reserve recently, especially around interest rate hikes. And then I also want to talk about Burry's warning again when it comes to the mother of all bubbles. I want to share my thoughts on how that will impact retail investors like me and you. This video is especially important if you're holding growth stocks in your portfolio, like I am. As usual, if you do learn something new, it would mean the world to me if you could gently smack the like button somewhere around here. And if you really like what I'm doing, consider supporting the channel via Patreon, where you get some extra perks. And no, this video is not financial advice or recommendation to do anything, because I happen to be a random Asian dude that popped up on your YouTube feed. So without further ado, let's go. Before we talk about the Federal Reserve update on when they think interest rates will go up, as retail investors, we should at least pay attention to where interest rates are heading towards. Because if we're holding growth stocks like Zip, Afterpay, or Twilio, which is a company that I own in my portfolio, in a rising interest rate environment, that will crush some of the valuations of these companies with little cash flows and really rich valuations. So understanding where interest rate is heading towards helps me size my position so that my portfolio doesn't tank by 60% when interest rates do inevitably go up. When it comes to the new Federal Reserve update, the Fed is seeing 2 rate hikes by end of 2023. This is a little bit misleading when it comes to this headline. I'll talk about more in just a second. Inches towards tapering. Now, tapering is the idea of slowing down the amount of bond purchasing they're doing in the markets. And this is the equivalent of when people are referring to money printing. They don't actually print money, they actually buy more bonds off the open markets in order to introduce liquidity into the system. The reason why the headline is a little bit misleading when they're saying that the Fed sees 2 interest rate hikes is because the Fed released something called the dot plot after every meeting. And these dot plots are essentially Federal Open Market Committee's members' individual estimates on where they think interest rate will be towards 2022, 2023, and beyond. You can see most people think that interest rate is not going to move towards end of 2022, but there are some people who do believe that it's going to move upwards. And towards 2023, most people can assume that interest rate is going to be much higher than where it was today. And frankly speaking, I personally believe that interest rate will inevitably go up in the future, but I don't put too much faith on believing interest rates will happen exactly like this, because it really depends on what happens in the market. If inflation does run too hot, we'll recover faster than we expect, which really seems like the case. We're going to get interest rate hikes earlier than we expect. And if we don't, then it's going to be a little later. So no one really knows. And don't hear it from me when it comes to not trusting the dot plot. Hear it from Chairman Powell.
Let me say a couple things. First of all, not for the first time about the dot plot. These are, of course, individual projections. They're not a committee forecast. They're not a plan. And we did not actually have a discussion of whether liftoff is appropriate at any particular year, because discussing liftoff now would be highly premature. It wouldn't make any sense. As you know, in our FOMC statements, the conditions that it expects to see before an adjustment in the target range is made. And it's outcome-based, it's not time-based, and as I mentioned, it's labor market conditions consistent with maximum employment, inflation at 2%, and on track to exceed 2%.
My biggest takeaway is that they're slowing down the amount of assets they're purchasing from the markets. And when it comes to interest rate hikes, they will only consider that if they reach their inflation target being consistently at 2%. And I think that most people would actually agree that we're probably past that point. But the missing piece is employment. If employment can recover faster than what people expect, then it's very likely that we're going to get an interest rate faster than what most people expect. So how does all of that impact retail investors like me and you that's probably holding some growth stocks in our portfolio? Now, personally speaking, I think that interest rates in the future going up is inevitable. Whether that happens in 2022 or 2023, that's really beyond me, and I'm not smart enough to guess when that will happen. But we also know that interest rates going up tends to hurt the valuation of companies with little cash flow and really rich valuations. So they tend to come back down to earth a little bit. So here's what I think and what I've done for my portfolio to prepare for a period of rising interest rates. Firstly, growth stocks is not off the table for me. I'm just more selective which one I include in my portfolio. And I'm focusing a little bit more towards growth companies with great cash flow and at a reasonable price. Secondly, I've kept my growth side of my portfolio relatively small. So even if we were to get another big drawdown, it really shouldn't impact me all that much. And finally, if our favorite growth names gets crushed, then I'm probably going to go on a shopping spree. Granted, you've done your research. So personally speaking, I don't think that all growth stocks are off the table for me. It's just the ones with really high valuations, with no cash flow, then I'm going to revisit those another time. The last thing I will say for this part of the video might feel a little bit on tangent, but I think that it's really important for retail investors to pay attention to macro, because we could get the business right, but if the macro environment isn't friendly to that business, then that stock pick might not work out for us for the next couple of years. For me personally, I have a goal to be financially independent in about 6 years. So I want to manage my portfolio in a way that will help me get there faster instead of waiting 5 or 6 years for that stock pick to pan out. The next thing I want to talk about is Michael Burry warning retail investors about the mother of all crashes. It's a bit dramatic, and this is actually a reiteration of what he said earlier in the year when it comes to speculation. I made a full video about that in terms of what he's warning us about, not including the index fund bubble. I will talk about that in a separate video, but this is a great video to watch next because he provided us some great insights on what to avoid. So check out that video after this one. But to reiterate his warning earlier in the year, he said, all hype speculation is doing is drawing in retail before the mother of all crashes. I don't believe this tweet is on Twitter anymore. He tends to do things like this. And he also followed up by saying, when crypto falls from trillions or meme stocks fall from tens of billions, Main Street losses will approach size of countries. History ain't changed. It's really interesting that he's specifically pointing at crypto and meme stocks. And I think that's a fair criticism given how much crypto and also meme stocks have basically rallied recently. And I know that this is a very unpopular opinion that people want to believe that stocks go up and to the right forever. But we all know that doesn't exactly pan out like that. Right now, if we look at the buffer indicator, it's 2 standard deviations above the historical average. So if GDP doesn't catch up, then these assets are very richly priced. Some people argue that the price of these assets are justified by how low interest rates are at the moment, not to mention the market itself is being propped up by stimulus checks. At the same time, some of you will probably hate me for saying this, stimulus checks will eventually wear off. And it's inevitable in the future, these valuations of stocks, crypto, NFTs that's way too richly valued will probably come back down to earth. That's one of the main reasons why after March and April, which I have to learn it the tough way for not paying attention to macro, I have shifted my portfolio towards more reasonably priced assets and companies that will actually do well in a high inflation environment. I'm not mentioning all of this speculative bubble news to scare you. It doesn't really matter what market you're in, whether that's real estate, crypto, stocks, or NFTs. They all go through market cycles. And depending on where the market cycle is, we can proactively manage our portfolio in a way that we can come out on the other end as an even better investor with an even better portfolio. That's the reason why I think that it's important to pay attention to macro and also not brush off some of the negative sentiment coming from more well-known investors like Dr. Burry. With my CMC market portfolio, it's currently worth 100,000 Australian dollars, and I'll show you my US portfolio in just a second. You can see that I separated my portfolio into value and growth. And as many of you know, I only started actively managing my portfolio for about a year. Before then, it's all ETFs or listed investment companies for me because I just didn't feel comfortable enough to pick my own company. And I know that many of you have questions in terms of why I went with VTS and not with a S&P 500 index fund. The main reason is that when I was allocating capital, I wanted exposure to the entire US market. Not to mention, at the time, Tesla and Alibaba was not part of S&P 500 and I wanted exposure. So VTS was the best for me. Over time, I added in Argo and RAM research, and you can see that ETFs, LICs make up basically 70% of this portfolio. With my growth stocks, it's actually mostly in an ETF in Asia. And the main thinking behind that is Western countries have borrowed so much money up to their eyeballs, whereas Asian countries haven't quite done that. So I wanted to allocate some capital to those regions just to make sure I have some exposure after the stimulus in Western countries wear off. At the same time, I have made a dedicated video on Micron, and it's this video right here, so feel free to check out that video after this one. I am not changing my perspective on this, even though it recently went down a little bit. I'm not too fussed. Novonix and Talga is both companies I talked about a lot on my channel. I really like them as part of the EV battery supply chain play. I blurred out this part of my portfolio because I've started a short-term side of my portfolio. And this is where I allocate some cash for the next 6 to 12 months and see how I go. I'm not day trading some of these companies. I am just focusing on macro, focusing on fundamentals, but most importantly, I'm using the short-term portfolio to work on my technical analysis skills. And one of the main things I'm learning about recently is the Elliott wave principle. So until I feel a little bit more comfortable to talk about it, I probably won't share this part of my portfolio. I do openly share it in Discord because I can, but it's a very, very small part of my portfolio. And currently I still have $2,500 I need to allocate in terms of cash. So I'll keep you posted on what I do decide to do with that money moving forward. With my stake portfolio, it's currently worth around 41,500 USD, which is approximately 50,000 Australian dollars, give or take. And I have to say that I am genuinely surprised by what happened after the Fed announcement. After the Fed announcement, the 10-year Treasury started going down, and that made no sense to me, but nevertheless I'm not complaining, and some of my growth stocks did benefit from that. So you can see that, well, firstly I made no changes on this side of the portfolio, but something like Twilio, Shopify went on a running spree, so that was nice to see. And I think that with this side of my portfolio, it's more predominantly on the growth side. So Tesla makes up around 8%, 9% of my portfolio. And Amazon, I think of Amazon more as a value stock, to be perfectly honest. Regeneron, Bristol Myers, these are value stocks. So definitely more part of the value stocks, part of my portfolio. Disney is more like a growth stock than the value stock. Twilio, definitely a growth stock. Lit is at the EV battery supply chain, so definitely more on the growth side. CVS, definitely on the value side. And Ozone, definitely on the growth side. The rest is definitely all growth. So I made no changes to this side of my portfolio. I'm actually really happy with my composition at the moment because growth makes up approximately 28% of my portfolio. So if we go through another drawdown, I should be okay sitting through it, no problem. And I don't plan on doing any selling because my capital gains tax bill is big enough for this year. So not really going to change anything on this side. I am continuously going to keep investing just because I'm that kind of guy. Like I don't really believe in investing a lot and then not investing for a period of time. I am more of a consistently invest kind of guy. So I'm going to keep doing that. And as usual, I'm not sponsored by Stake, but if you do want to try Stake for yourself, I have left a link in the description box below. Thank you so much for hanging out with me all the way to the end. If you did learn something new, consider gently smacking the like button right there. Subscribe to my channel, click onto the bell so that when I release future videos, I can let you know. If you're still bored, I left a video on the screen that I think it's incredible to watch next. And as usual, Otto will always do the honors, and I'm gonna see you very, very soon.